With me today is Greg Dickerson. Greg, great to have you back on the show.
Hey, Tony, thanks for having me. And just want to apologize to everybody. I'm getting over COVID. My voice is going to be a little scratchy and I got to drink some water in between. So we'll see how it goes.
Well, appreciate you. Even though you're on the road to recovery, you're taking the time to do this. But we've been talking for months. There's just a lot going on right now with markets, even in the European markets. Let's start off with what the Fed had to say. Tell us about the recap of what was released yesterday.
Yeah. So yesterday and then today, Chair Powell spoke again, and it's the very consistent message that they're going to stay higher for longer. They're going to do whatever it takes, as long as it takes, to get inflation down. That's their number one primary concern. And I think a lot of people are starting to see why, in terms of the damage inflation can do versus a market decline or something like that, or even a recession, mild to deepish recession. Inflation is way more damaging, and you're seeing it in Europe, where with energy and the prices of energy, it's putting people out of business, and that's a big concern over there right now. They raised 75 basis points there. So I think it's a pretty high likelihood, not positive 100%, but pretty high likelihood that the Fed's going to go ahead and hit 75 basis points again, because what they've done so far has not had any effect. The economic data coming out is still strong. Jobs is still good. Unemployment claims are lower than expected. More jobs are being created. The PMI index, all that stuff's coming out looking pretty solid. So that's telling the Fed we can still continue to tighten, and we have a long way to go yet. So now that threshold has been raised up, expecting a Fed funds rate around 4 to 5% ultimately. We'll be in that 3.5 to 4 after this next 75 basis point hike. So they could probably slow down the rate of hikes, but they're not going to stop hiking. So there is
Yeah,
no pivot like the markets were playing off of back when we had the little rally in July. That was the narrative, was that the Fed had pivoted with Powell's neutral comment. And obviously everybody knew that wasn't the case, but hey, great rally. That's what bear markets do. You get some really nice rallies. That one was one of the bigger ones. And now we're continuing the orderly unwind and declination of markets. So I'm on record of saying we haven't seen the bottom yet in traditional markets or crypto. I don't feel like we have. I think we're going to see lower lows. I don't know how low. That will depend on what does the inflation print look like next month on the 13th? What does the Fed do in response to that? How does the war continue to evolve? What does the China-Taiwan situation look like? So there's still a lot of things out there from a global macroeconomic headwind standpoint that creates that risk-off environment. So until we get inflation under control, until the Fed can stop, and until we know that the recession, we can quantify a recession, if we even enter into one, there's debate of whether or not we'll actually enter into a real recession, meaning significant job loss, companies going out of business, things like that, real GDP contraction versus, this technical stuff that we've been going through. So once we quantify those, then you can put a base in and you can look for markets to reverse, especially if the Fed is in a situation where they can reverse course and start lowering rates. But right now, there's no indication they can do that before the end of 2024.
yeah. There's so many headwinds, and it, like to your point, it doesn't seem like what they've been doing is having much of an effect, or what they would like it to. So do you see us going into next year with additional rate hikes, and possibly we're seeing rates above 6%, things along those lines?
The Fed funds rate,
Yeah.
well, right now the target is 5. So we'll just have to see what the effects are and whether or not they're getting inflation under control. Like I said, the debates out there right now with economists, analysts, investment managers, the research is showing, and their data is indicating that it's going to take probably the end of 2023 before you see any real reduction in inflation. They don't think it's going to happen anytime soon. So, how quickly will inflation come down is going to determine what the Fed needs to do. So they're going to continue to hike. The question is it going to now drop to after this next 75? If inflation starts to taper a little bit, they can back off and go to 50. But if we don't see the economy slow and inflation taper, they're going to keep hitting it hard. And we don't know yet how high that rate could go. But right now, the target is 4.5 to 5%, somewhere in that range. Right now, really 4, but upper level of 5%.
So, of course, Jerome Powell, he's been jawboning the markets too. And Bitcoin saw a dump earlier this week. It's back up a little bit. Ethereum still looking a bit strong because of the merge coming up. Maybe you can share your screen and walk us through what you're seeing for Bitcoin as well as Ethereum.
Yeah, I've got a really important line that I'm watching on Bitcoin right now. So this blue line here, that is the 2018, 2019 high, 2017, 2018 high. And you can see that Bitcoin now broke below and is rejecting off of it perfectly. So unless and until it can get above this line and kind of confirm and continue, you can't expect the bottom, to be in. Even if it does, some of this number comes back and just dances, but it's really got to get above it, confirm it, and then kind of move on and or stabilize off of it. So this is your line in the sand right now. Right now we're rejecting below it. And what you can expect there is the way this is looking right now is that it could kind of continue and then just kind of work its way down, consolidate, pop, and then, just kind of continue basically what it's been doing, this whole way, all the way through with, all these different levels. It's kind of a very, repeatable pattern that we've been seeing throughout the last several months with Bitcoin. And it's, just that level to level to level to level working its way down. Now, the interesting thing is what we haven't really seen is any real capitulation yet. I know there's a lot of, this is what's interesting. So there's a lot of technical confluence that, the bottom is in. So when you look at the moving averages and you look at this weekly that I was talking about weeks ago, where this 50 and 100 week cross, last time the bottom was in. And the price only dropped about 10% from where that area was, prior to the low, which it did here. Same thing, it dropped about 10%, or 10% above where the low was. That's kind of where it bottomed out at and kind of leveled off from there. Last time the low was in over here, and the next low confirmation was about 10% above where that low came in when these moving averages crossed right here, right? So we've got that confluence. We've got, 75% down. In the past, it's been 85%, here in this area, 2014, I think it was 85, 2011 was 70 something. So you're 75% down. And there's, a few other things like the hash ribbon buy signal and, some other technical confluence that, a lot of analysts have been showing on-chain data, the Puel multiple, just all these different things that would tell you that the bottom is in. And what a lot of people are looking at is, these fractals of reversal right here, this bottoming pattern right here that Bitcoin went through back in 2018. But the thing was this was where the Fed pivoted. So this whole declination in 2018 was the same thing the markets went through when the Fed broke the markets the last time they did a tightening cycle. So if you look at like the S&P, this is that time frame right here of 2018, and there's your bottom, in December of 2018, right in this area. And then when you go back to Bitcoin, December of 2018, there's your bottom. This is where the Fed pivoted, started juicing the markets again. So for me, the markets were back off to the races here, traditional and Bitcoin, and then kind of got derailed by the COVID news, because COVID news started becoming an issue around the fall, of 2020, when it came on the radar of a lot of the institutions and, health community. But I think the bull market was really starting, back in this area, and would have continued had we have not had, obviously the COVID issue. Sure. And the real thing is we've never seen and never had markets, traditional or crypto, settle without the Fed intervention, ever. So the Fed's, this was created after the Fed did their thing in 2009 after the great financial crisis. That's when Bitcoin obviously was invented, and everything else followed. And we've been in a QE, cycle where the Fed's buying instruments, whether it's treasuries, whether it's mortgage-backed securities, stocks. At one point, the Treasury was actually, buying stocks and GM and all that to, shore up those companies, taking positions in those companies. But, more importantly, we've had zero interest rate, which means investment funds, hedge funds could borrow money to deploy into the markets at very cheap to little cost. So the markets have never had a chance to really settle without Fed and Treasury intervention, central bank intervention around the world. So that's what we're in the process of doing right now. That's why this is happening. That's what this is all about. When you look at traditional markets, like the Dow Jones, the NASDAQ, and the S&P. This is a very orderly repricing and unwinding and anticipation of Fed intervention. That's kind of what's keeping it up. That's what's keeping this big, 2020 style, 2009 style crash from happening, is that the markets still are expecting the Fed to step in when it breaks like it did back here in 2018.
When do you think that realization is going to kick in, whether it be for crypto stocks, and is it going to be like later this fall or winter where it's like, oh boy, they're serious, and it's happening in Europe as well, and then all of a sudden it's panic, and then we got that big crash?
As soon as things start to break. So if the bond market breaks, the credit market breaks, they start unloading treasuries. We'll see what that does to the bond market. When they start unloading mortgage-backed securities, we'll see what that does to the housing market. And we'll see how the banks can hold up in terms of the reverse repo and the credit markets and things like that. So they're not too concerned about financial markets. They want people to feel less wealthy. So they want housing to come down and correct. They want financial markets to come down and correct. It's really going to be credit markets. If it gets to a point to where companies can't borrow money to do business, then that's when the Fed has to start making some decisions. And then the question is, well, what are they going to do then? Where's inflation when that happens? And what are they actually able and capable of doing? You get into a Japan situation, but right now they're pinned by inflation. They cannot buckle because of inflation.
But the thing is, could we be in a scenario, because we're seeing like they're releasing these inflation packages, right? And they're starting to offer up free money in different ways. Will it get to a point, and this may be a difficult question to answer, and it involves a bit of politics, but we're not going to be able to get inflation to 2%, what they're looking to do. Maybe.
Well, so you have monetary and you have fiscal policy. So monetary is what the Fed and Treasury does through interest rates and asset purchases and things like that, issuance of debt. Then you have fiscal policy, which is the government spending money. So these two are right here, right now. The Fed's trying to tighten, Treasury's trying to pull back. They want to unload the balance sheet, but at the same time, you have Washington continuing to put money on the streets with their, Inflation Reduction Act and other things that are happening. And you see what's happening in Europe. They're trying to stabilize energy prices, so that's a stimulus. States have started their own stimulus with gas prices. I don't know that we've seen the end of the gas price situation yet. Oil is on the decline. The OPEC does not like that. They want to see $90 or above barrel. So we'll see what happens there with oil as we get into the fall and winter and energy prices go up. And there's speculation the gas could be back at $5. I don't know what that catalyst is, but we'll have to wait and see. But yeah, right now, central banks and policymakers around the world are at odds with each other in terms of stimulus versus, restrictive policy. Here's Ethereum here. And again, all this is, a lot of this is driven by the ETH merge. As soon as that happens, you can expect all this to unwind and retest lows again. Bitcoin and the rest of crypto will probably follow along. Because they're all kind of tied. And if you look at, let's just blow up this hourly price action here over the last few days, it's the exact same price action, just different degrees, every asset. So this is all automated algorithmic trading that's going on here and speculation, some popping more than others, but all your major altcoins, they're all following the exact same price action. So this is not retail just all of a sudden deciding the other day, hey, let's buy.
Right.
This is all very deliberate. And a lot of arbitrage plays, a lot of algorithmic trades, things like that.
So another hard question, where do you think Bitcoin bottoms at, and Ethereum as well? Once a realization kicks in, and then it's all the way down.
So that's where what I was going to say a second ago, the biggest risk for Bitcoin is once you start getting down to the next level, which is 15.5, 16,000. Once it breaks that 17.5 level that we put in June, the next stop's going to be 15, 16 and a half, and then ultimately 10. Well, where liquidations and margin calls start happening is in that 15,000 range. So if it can get there, and that's what's being defended right now. So some of the larger holders like the Michael Saylor, he'll get some margin calls, when it starts getting down those levels. There's other people that are leveraged and will get margin calls, collateral calls, where they've borrowed, they've pledged their assets as collateral. So as price starts getting down close to those levels, then you'll see a big unwinding. And that's the other thing that we haven't seen. I'm going to go back to this. Is that real, capitulation. So, like I was saying on Bitcoin, what a lot of people were saying was, this is a bottoming structure right now that we're in, because when you look at it on the hourly, it kind of looks like it, not on the daily. But the thing is, when you really look at it, it looks more like we're here before this big final capitulation. And the reason I say that is, obviously price action kind of looks like it, this little bump here, a little bit of consolidation, then bam, before it falls off the cliff, waiting for the Fed's next move and all that. So I think you're going to see consolidation underneath that prior all-time high, and then ultimately that final capitulation. And a couple of reasons I say that, where it goes down here, and then that puts you back, into that $10,000, $12,000 level. And the reason I say that is because there's a lot of technical confluence at the bottom's end. I mean, all of the technical indicators, there's a lot of big YouTubers there, right? I mean, it looks like it should be in based on history, but we're in a very different macroeconomic environment now, very different monetary environment right now. We're in a tightening risk-off cycle. So it is different this time. So, there are too many people that still think the bottom's in. Like a lot of people are saying, if you expect lower prices, then, it's not going to go there. Well, there's more people saying the bottom's in and expecting the bottom to be in right now in traditional markets, as well as, Bitcoin and crypto, than there are saying there's going to be lower prices. The minority is calling for lower prices. They're just a little bit louder, and people will amplify that because they don't want to hear it. Yeah. And, there's no guarantees. I'm not saying it's going to do this, and I'm happy to be wrong that, that we're going to see new lows, but it's just the most probabilistic outcome right now, given where we are from a risk standpoint, from a global macroeconomic standpoint, from a geopolitical standpoint. There's still a lot of things out there that have yet to unwind. And unless inflation just goes away, you can't expect risk assets to reverse because the central banks and the Fed have to continue to do their job and, get that inflation pressure under control. So, to answer your question in terms of how low could it go, it's really going to depend on where we're at when we get there and what kind of liquidations happen, margin calls happen, because if that starts to happen, well, then you can see it tank right on back down. The good news is we know where it leveled off the last two times we had a big crisis, but the Fed jumped in both of those times. So we do not know all the way back to 2009. And then fast forward to 2018, 2019, fast forward to 2020. Those were all Fed and central banks jumping in and propping up the markets and the economy. So we don't know where things would go if they can't and won't do that this time. So that's what's kind of interesting. And I think it'll only go so low because there is a lot of capital out there that would deploy, as these assets, start to drop. And, there's also a narrative out there for people that say, hey, Bitcoin's at $500,000. What difference does it make whether you bought at 20,000 or 10,000? Makes a huge difference. You can buy twice as much.
Yeah.
Even at 15,000, you can buy 30% more Bitcoin. So that makes a big difference if it gets back to 100, 500, a million, wherever it ultimately gets to, you want to have 30% more. But if it goes up to 25 from here, you don't lose anything because you're only buying about, 10, 15% less than you could have. So you've got more risk buying now if it goes down than you do if it goes up.
So I was going to ask you that question. Are you buying or are you waiting to see if it's going to, go lower?
Yeah, I'm waiting for the next leg down because that's what I believe. I believe we're looking for another low. And then once we get there, I'll see where it levels, what happens in terms of liquidations, things like that. Is it going to just blast right on through? Or, can we stabilize? And again, Bitcoin is the most speculative risk asset on the table. Okay, it just is what it is. Yeah. Now it's an exponential risk asset, and the only thing that rivals it is meme stocks. So Bitcoin's a meme stock. I mean, it just is what it is, and it is an emerging technology, and there is scarcity and things like that. But scarcity and limited supply does not always equate to higher prices. That's a narrative that drives prices in the space. What drives prices in Bitcoin? More capital. So you need more risk capital coming into the space to drive that price up. And the bulk of that risk capital is going to exit when it hits certain levels. So, it's kind of that, it's just kind of the nature of a risk asset, but it is exponential. So, if if I see it drop, down to 10, 15,000, I think that's where I'm interested in a longer, bigger, longer move, where I think you could get 3, 4, 5x. Are you going to get a 10x or 20x like we saw last time? If it gets down to 4,000, sure, I think you would. Absolutely, because a lot of people would be in it then. 10,000, people are still going to be worried. So, but that's a good level, I think, where, I'm not sure it'll break that if it gets there, because there is a lot of capital out there, kind of targeting that number. But we didn't think it'd break 30 either, and then you didn't think it'd break 20. Not you or me, but in general, it just seems surprising that it was able to break those levels, because the narrative was all this, capital was going to come in at 30,000. It was going to come in at 20,000, and but I'm pretty confident it'll come in at 10.
Well, part of me hopes you're wrong, but then I'm also like, if it goes to that, I'll be buying up like crazy.
Yeah, it's kind of a win-win. I mean, like I said, I'd love to see a base be put in here, but the cards just aren't, the decks aren't stacked in that light right now. There's just too much stuff out there yet. There's still a lot of risk for a deep recession. Investors are playing it safe right now. It's risk off, just is what it is. But if Bitcoin can hold and get back above that, 2018 high, then, we're going to be in good shape. Right now it's rejecting off of it. And if it can't reclaim that, it's going to go down and test the lows. And it's either going to hold there for a little bit or it'll break right through it.
Let's talk about real estate. So I've been looking at, locally what's happening in the markets here. And I'm seeing homes being pulled off the market. I'm seeing huge price cuts. What are you seeing overall? And where do you think, prices are going to drop even more?
Yeah, every market's different, and the price reductions we're seeing are price reductions from really all-time high prices, and maybe even some unrealistic prices, sellers that are just kind of reaching, and that were reaching too late, so they're contracting. What's really interesting right now that we've never seen before is we've seen demand destruction because rates are so high. Buyers are just disappearing. So all across the country, builders are pulling back. You're seeing contracts get canceled. You're seeing mortgage applications, refis just non-existent, and you're seeing buyers walk away, from deals. So, and at the same time, you're seeing sellers pull their houses off the market and not list because they don't have any options. There's no inventory for them to go to, and the rates are too high. So they don't want to sell now and go somewhere else and pay the prices that properties are at now with double the interest rates. Right. So it only makes sense if prices come back to where they were as interest rates have gone up. Interest rates are double, almost triple what they were, 3 or 4 months ago when they were at 2.5%. You can still get interest only, which is a little cheaper, but now you have no inventory and prices have grown exponentially. So it just doesn't make a lot of sense. So we've never been in a position in the housing market where we've seen inventories decline. Days on market in general are still less than a month in most markets. In some markets, you're still seeing multiple offers and stuff selling days. So it's still very, very unbalanced and unhealthy, but it is more of a buyer's market. And then every market's different. So there are big markets that are under pressure, like Nevada and Arizona and Texas. Some areas in North Carolina are starting to feel it. So,
well, if you got cash, it's perfect, right? Because the prices are going down. You don't have to worry about a mortgage. You can go grab up maybe some properties.
Potentially, but you're running the risk that, the market's going to decline some more. So, you just have to make that decision for yourself. But yeah, if you're a cash buyer, you're not thinking about rates. And that's what we're seeing a lot of still happen. People coming in with cash, especially from California, the Northeast, and coming into the Southern belt where things are cheap to them, even at inflated prices. And that's kind of what drove a lot of those prices. People coming out of New York and New Jersey and Connecticut and those areas. And, stuff's cheap when you start going south.
Yeah. Greg, always insightful information, and we'll have to talk soon because things are unraveling. It's getting bloody out there, and we got to keep a close eye on it. But thank you for joining me today.
Yeah, I wish I could be, everybody wishes they could be more exact, but it's data dependent. You just never know. I mean, if things escalate in Ukraine, if China invades Taiwan, if, the bond market blows up, if inflation prints 10%, there's, 9%. There's a lot of things out there that we just can't control, and all we can do is be prepared for when they do happen. Yep. And it's all about preservation of capital. So these things I talk about from a risk standpoint, Kathy Wood is the classic example of zero risk management. Zero. Fantastic research, right. Great, individual fund, whatever, but zero risk management. And, we're starting to see the narrative of, oh, nobody's ever lost money in crypto or Bitcoin that bought 5 years ago. Well, they're underwater right now. So, that 5-year time horizon, that 10-year, time horizon that a lot of people use as a narrative to make excuses for buying at the top. I got a 5-year time horizon. That doesn't always hold true. And I've been through it, and I've seen it in real estate, and I've seen it in stocks. It can take years for a market to recover, much less bottom. So the risk is we could be bottoming for years before you start to recover. You're going to get bounces, but I'm talking about a full-on bull market recovery. It could take years. We've all been conditioned that it's going to be instant because the Fed comes in with the cannons blasting. That's the only thing that has ever saved the markets. And even with that in 2009, it still took 5 years for that to come back.
Right.
And it took the real estate market 10 years to get back to, where it was before. So that's why I talk about risk management and preservation of capital. So when it does shift, you've got the assets and the liquidity to take advantage of it. And that's where you're going to create those real generational opportunities. And, don't listen to everybody telling you, this is your last time to buy, whatever. Historically, from the technicals, these levels, have been the best time to buy, for Bitcoin in the history. But this is a different history right now. It's not the same.
Mm. Yeah, that's good advice. You got to be caution, take caution and be cautiously optimistic, in what's happening.
Always optimistic, but hey, you want to have money at the end of the day to take advantage of the opportunities.
For sure. All right. Thanks, Greg. Appreciate it.